Today we welcome you with a keynote from Matthew and Merle, Meet the Blockchain Unicorns. Matthew, could you briefly introduce yourself and the company?
Thank you very much, Nadia. So I am both the managing partner of Fifth Era and also of Blockchain Co-Investors, which is the leading US blockchain venture fund of funds. And we'll talk more about that on this webinar. And then I also help run CRYPTOCURRENCIES, which is the most active early stage investing organization in America.
Thank you so much, Matthew. Could you start with your topic? So let's see how blockchain unicorns look like.
Sure, happy to. Can you see the screen now, Nadia?
Yes, sure.
Yeah, so in the next 30 minutes or so, we're going to talk about the blockchain unicorns that already exist. There's about 16 of them around the world. And I'm going to talk about each of them individually and a little bit about the dynamics. I think that for everyone on this LATOKEN webinar, obviously your aspiration and our aspiration are both to be investors in the best blockchain companies, the projects that grow to be the largest and most successful. And so it's always worthwhile to take a look at who's accomplished a great deal of success in any given industry when you're going about your own investing activities. So as I mentioned, this is us. My wife, Alison, who's on the left, is my co-partner, and we run Fifth Era, which is our family office, and Blockchain Co-Investors, which is our focused fund, entirely focused on blockchain investing. And Alison sits on the boards of Silicon Valley Bank and Fiserv, and used to be the CFO of BGI BlackRock, which is the world's largest asset manager. And you can see my background as well. I've already mentioned that I work with CRYPTOCURRENCIES, which is the leading angel network in America. And I'm also an advisor at Securitize and SFOX and BitBull and some other blockchain-related companies and projects. Today, we're going to talk about these 16 unicorns. So if you look at the first column, at the end of 2018, the world had 9 blockchain companies or projects building on distributed ledger technology that were worth more than $1 billion US. At the end of last year, 2020, that number had risen to 16. And you can see them listed. The ones that are shaded in blue are ones where we are investors. And I'll talk at the end a little bit about how we have become investors in 10 of the 16 blockchain unicorns. If you look at the fourth column, you can see that they're split roughly equally between China and the US, with a couple in Europe. The main ones in Europe being in there for very specific reasons in Malta, Switzerland, and the Netherlands, and we'll talk about those too. So this is these are the blockchain unicorns that we're going to be going over. When we think about blockchain investing, we see 8 broad investment themes. And I'm going to talk through these very briefly because it helps you to understand why some of these blockchain companies are becoming valuable so quickly. And so this, as you'll recognize, is a traditional software stack turned upside down. So the foundational layer is really about bringing to the world new ways to do compute, store, search, and secure in a more distributed and decentralized way. And of course, that is what the distributed ledger technology is so good at. But it requires us to have protocols and platforms and ways to incentivize networks and network participants. And of course, some of the most important foundational layer technology is about building registries and identity systems and solutions and ways for us to think about the provenance of information and data and assets and so on a global basis. So this is the foundational layer investment themes. Now, because blockchain is really about the internet of value and allowing us to transact value in secure and immutable and trackable ways, so the transactional layer in this case tends to focus on financial services, monies, and assets. And so obviously in the distributed world, we have to build retail wallets and money services to enable currencies and cryptocurrencies, crypto monies and tokens to be shared and transacted. We need to build the peer-to-peer marketplaces and exchanges to enable that activity. And then, of course, as we're seeing right now, we need to build out globally the institutional exchanges and custody solutions and settlement solutions that help the biggest institutions participate in cryptocurrencies and crypto assets. And then finally, on top, we have the application layer, which is where people take everything that's below the foundation and transactional infrastructure and technology, and they use it to build, on the one hand, enterprise solutions, which have to do a lot with the supply chain, logistics, and the Internet of Things, and so on. And secondly, we're also applying these same technologies to find new ways of interacting with content, to have social platforms and digital entertainment platforms that are moving away from the advertising model to new ways to motivate individuals and get them to benefit directly from their clickstream activities. So these are the investment themes, and I'm going to use this now to talk through the blockchain unicorns. So on this page, I have the same 16 blockchain unicorns that we had on the earlier page, and we've organized them by those investment themes. This is now turned upside down, so you can see the foundation on the base, transaction and application layer. And then we've organized them by North America, Asia, and the rest of the world. And I'm going to talk through all of these. We are investors in a number of these, and I'll come back to that later. So I'm going to start at the foundational layer. And as you can see, about half of the blockchain unicorns are focused on the foundational layer. We'll talk about those. About half of them are transactional layer companies that are building out financial services, money, and asset infrastructure. And then we have very few, just one right now, application layer player, Figure, though that's sort of a hybrid because they have their own blockchain provenance technology within Figure as well. So the first group that we're going to talk about are the miners. They're all at the foundational layer, of course, and they're involved in the mining technology that does the computing work that validates and secures each of the blockchains that we're currently working with. And there's really 4 companies to know here: BITMAIN, EBANG, CANAAN, and then in Europe, BitFury. And I'm going to talk about each of them, but BITMAIN is by far the most established of these companies. Current valuation, 12 billion or more. BITMAIN is a vertically integrated mining company. And what that means is that they don't just get involved in establishing Bitcoin mining facilities. They actually, or indeed selling technology to miners, they actually create the ASICs, the underlying application-specific integrated circuits that are streamlined and created specifically for the mining of cryptocurrencies and specifically Bitcoin. And then they build around those ASICs their purpose-built technology. They go under the brand names Antminer. And so they create Antminer mining technology, and then they either use that themselves in their own pools, or they sell it to third-party pool companies, mining companies and pool companies that are basically using those servers to mine for Bitcoin. So that's basically the focus of BITMAIN, based in Beijing and founded by Jihan Wu and Mikri Shan. And I think the biggest single challenges for BITMAIN, which is by far the leader in the space, are mostly internal. There have been substantial issues within the company, and particularly between the co-founders, Jihan and Mikri. And we're watching to see what that means for BITMAIN itself and its ability to continue to be the leader in the space. CANAAN, on the other hand, CANAAN is a second miner based this time also in Beijing and founded by NG Shang. And CANAAN goes under the brand Avalon. And so you can see on the left-hand side both examples of CANAAN ASICs that are purpose-built for Bitcoin mining, and also the Avalon miner that they've built on top of those ASICs. So once again, a vertically integrated company. And in this particular case, CANAAN has risen to some prominence by being very good at providing high quality technology to support third-party miners. Still vertically integrated, as I mentioned, in the case of BITMAIN. With CANAAN, their business model, and it's true of BITMAIN too, relies very closely on two principal variables. One is the value of the cryptocurrency itself, of Bitcoin. So what is today's cost of Bitcoin? So the miners know what they'll be able to sell their mined coins for. And of course, what are the costs of doing that mining activity, driven by energy costs. And so part of the reasons we see the prominence of BITMAIN, CANAAN, and in a moment EBANG, is because they have access to large amounts of excess energy in Sichuan and other provinces, particularly where it's either hydro or geothermal energy. EBANG is the third, this time based to the south, in the south of the country, in Hangzhou, and founded also in about 2013. All three of these companies have been in business for the better part of a decade. The brand is eBit, so EBANG creates the eBit miner, and that is available primarily to independent mining companies. So even though each of BITMAIN and CANAAN and EBANG do experiment with their own pool activity, and for BITMAIN that's a very large business, for EBANG they're primarily focused on selling their hardware to third-party miners. And then we have one European or North American and European mining equipment company that has also raised itself to the value of a unicorn, and that's BitFury. And BitFury is headquartered in Amsterdam, but has a substantial presence here in the US. And founded by Valery Vavilov back also a decade ago now. BitFury is viewed as a very attractive source of hardware, particularly by miners in parts of Europe and in parts of North America. Its branding is the TARDIS line, and you can find more about BitFury at bitfury.com. So all four of these companies are focused at the foundational layer. They're creating hardware. Most of them are vertically integrated, so they have the best and the lowest priced access to the underlying ASICs. They're then building their equipment on top of that and selling it to third parties. And in some cases, they're also operating their own mining activities as well. So that's really takes us through the half of the bottom layer. We have a few other companies that are also foundational: Ripple, BLOCK.ONE, and then DFINITY. And I'll talk briefly about these companies. Ripple is a very different company. It's not a mining company. It does a couple of different things. First and foremost, its goal is to be the leader in remittances, and particularly international remittances. It was founded back in 2012, and here in the US, it's backed by sort of a who's who of the blockchain investment community. People like Andreessen, Blockchain Capital, which is why we're investors, as well as DCG, Digital Currency Group, and a host of others. Ripple's initial founders were Arthur Brito, David Schwartz, and Ryan Fugger, and then Chris Larson and Greg Kidd and others became involved. And it then, in addition to focusing on remittances, of course, created its own cryptocurrency, XRP. And a lot of the value of Ripple today is valued at about $8 billion, but a lot of the value of Ripple is actually embedded in its ownership of a large percentage of the XRP that's been issued. And Ripple also helped create Ledger, and we can talk more about that at another time. But for the purposes of today, the focus on Ripple is on taking traditional international remittances technology like SWIFT and displacing it with lower cost, more reliable, and real-time ways to move money around the world. And that's really the focus of Ripple. Block One is, in some respects, a similar type of initiative. The focus is different. So rather than Ripple's focus on payments and remittances, Block One, their goal was to build a blockchain that was extremely easy to use for building decentralized applications. And Block One, founded by Daniel Larimer and Brendan Bloomer, and then supported by Brock Pierce and Ian Grigg, did a very successful launch of the EOS cryptocurrency, which is today one of the most highly valued cryptocurrencies. So Block One's value is partially its own equity value, and it's partially the value that comes from owning a large portion of the EOS that's been issued. The headquarters is relocated from the US to Hong Kong, and you can track more about this company as well. It was initially backed by BITMAIN, which is interesting, as well as Blockchain Capital, where we're involved. And I failed to mention Alison chairs the advisory board of Blockchain Capital. And Peter Thiel is also involved in this company. DFINITY, based in Switzerland, is actually the newest of the foundational layer Bitcoin unicorns. And the goal of DFINITY is to create a superior way to compute in a decentralized fashion. So just as we originally did all of our compute on mainframe computers, we then transitioned that to centralized cloud-based computing centers run by, here in America, people like Amazon and Microsoft and Google. So DFINITY wants to move that to the next stage of having a truly decentralized internet computer. Dominic Williams is the visionary that founded the company just a couple of years ago. So this is a new player in the space. And it was backed by, again, a very good set of investors, including Andreessen, Bitbull, and DCG, where we're investors, and Polychain. And as I mentioned already, the headquarters in Zurich, but they also have a substantial presence here in the US. If we're going to talk about the base layer, we should also talk very briefly about the currencies themselves. So as equity investors, we focus most on companies that are using distributed ledger, and our goal is to be equity investors in those companies. But of course, you don't have to be an equity investor. You can simply buy cryptocurrencies. And so this is a snapshot of the value of the world's cryptocurrencies. It's a little bit out of date because obviously the value of Bitcoin is, and in fact, many of these have appreciated since I took this screenshot a month or so ago. But Bitcoin is obviously the largest, and we've talked a little bit about the miners working in that ecosystem. Ethereum, the second, and then you can see in the third column, Litecoin and XRP, and then EOS is also substantial, as well as NAM. So you get a sense of which are the largest of the cryptocurrencies by value. So we've completed the base level, the foundational layer. Now I'm going to talk about the transactional layer. And most of the Bitcoin unicorns in this space are creating wallets or money services or exchanges to enable the use of the crypto monies. And so I'm going to talk through each of these. There are 7 in total, plus Digital Currency Group, which is a bit of a special case. Coinbase is the leader in this space here in the States. I'll talk about Binance in a moment, but Coinbase, based in San Francisco, was founded about almost 10 years ago now, and backed by a host of great investors, including Blockchain Capital and DCG, and also One Confirmation were investors as well. Brian Armstrong and Fred Erzam had the vision of making it extremely easy for people to hold and transact in a mobile-first way. And Coinbase, at its guts, is the easiest way, or is intended to be the easiest way, for new investors in crypto to gain access. Since its founding, Coinbase has also added on institutional technology through Coinbase Custody, and just yesterday announced the acquisition of Tagomi to continue to build out its institutional focus. So that's Coinbase. KRAKEN is the second of the big US players, founded by Jesse Powell, also 10 years ago here in San Francisco. backed by DCG and Blockchain Capital. You're seeing the same names. The leading investors in the space are the investors in most of the unicorns. And KRAKEN also intends to be the simplest crypto exchange and is a competitor to Coinbase. Circle began in a very different way, founded by Jeremy Allaire and Sean Neville on the East Coast of the US in Boston. And initially it was meant to be a peer-to-peer wallet and payment solution. So it was enabling individuals to share money, transact or lend or borrow money from each other. And it was supposed to be a very simple way to affect that type of activity. Backed by Blockchain Capital and DCG, General Catalyst and Pantera, it's risen to be a very substantial player in the space. It made a variety of acquisitions and broadened its focus. And today it's beginning to narrow focus again and has been shedding a few businesses such as Poloniex, the European exchange player that it had acquired a little while ago. Robinhood is the fourth of the big US players, and it came from a very different place. So whereas the others that I've mentioned began as payment and wallet companies, in the case of Robinhood, their goal was to be the simplest way for digital natives to buy and invest in public and private securities in a mobile first platform. And that's its original focus, backed by Sequoia and NEA and Ribbit, all leading Silicon Valley investors. Vladimir Tenev and Baiju Bhatt initially intended to be the easiest way for mobile investing. Based here in Menlo Park, as crypto became more and more important and as digital natives wanted access to Bitcoin and other crypto monies, so Robinhood opened up the crypto portion of Robinhood. And whilst we don't know what is the balance today of their revenue from traditional stocks v cryptocurrencies, it's our belief that at this point, Robinhood should be thought of as being one of the blockchain unicorns. So these are the US players, and the US players all have to operate in a compliant way based upon SEC regulation. Now, obviously, there are offshore players, and the largest of those is Binance, based in Malta, one of the only three blockchain unicorns from Europe. Binance, founded in 2017 by Changpeng Zhao and Yi He, is probably the leading global crypto wallet and exchange. And their strategy has been to have a much larger number, a much larger variety of tokens that you can invest in and trade. Now, from a US point of view, and I'm here in San Francisco, that raises issues because we are only allowed to buy and trade regulated and approved securities. And in the case of Binance offshore, there are many other tokens and securities available at Binance. Binance has also created a secure, compliant version of Binance, Binance USA, which we as US citizens can have access to. But since I know a lot of people are watching this webinar in Europe and in other parts of the world, and that token has a global footprint, Binance needs to be on the list of the world's largest transactional layer unicorns. Now, Liquid is the Japanese equivalent, founded in 2018 by Mike and Mario. It's based in Tokyo. It was backed by a group of American investors, Coinbase, IDG, and Ripple, and also by BITMAIN from China. And it's a very simple wallet that enables you to buy, sell, and trade crypto. And in that sense, it's very similar to a Coinbase, but it's a Japanese based company. And I believe most of their transactional volume is from the Asian part of the world. And then we have to talk about BitMEX. BitMEX is also a leading crypto exchange, but it's also a derivative trading exchange. And unlike most of the others, it provides its investors with very high leverage, up to 100 to 1 leverage on the BitMEX platform. Founded by Arthur Hayes, Ben Delo, and Sam Reed back in 2014. It's today headquartered in the Seychelles. It is a very active place where many investors go to buy and speculate on crypto monies. We have some reservations about the scale of the leverage. Leverage is a double-edged sword. If you're a trader and you have leverage, you obviously can gain more on the upside, but you can lose everything on the downside. And BitMEX, of course, has had a few outages in the last few months when we've been seeing a lot of volatility in the principal cryptocurrencies. But nonetheless, BitMEX is a substantial player based in the Seychelles. So now we've talked about the transactional layer, and we only really have two more companies to speak about, both based here in the US. The first of these is the Digital Currency Group. And the Digital Currency Group, founded by Barry Silbert, is based in New York. Barry had been the co-founder of Second Markets with Phil Reichert, who's a good friend of ours. And he then decided to use some of the proceeds from the sale of Second Market to launch this new entity, Digital Currency Group. And so the principal investors here were Barry himself and Bain and RRE Ventures, which are two very established US investment firms, RRE with a particular focus on fintech and crypto and blockchain investing. Barry's vision was to create a company, a holding company, that had a variety of activities within it. So it's a strategic investment holding company, and within it, it has a couple of properties that we need to call out. One of them is Gemini, shown above on the left-hand side, which is one of the leading exchanges in the US. And below is Grayscale, which creates products such as GBTC that allow investors to invest in Bitcoin or Ether or Zcash or other products through traditional investment accounts. And at least in most of the world, traditional investors and traditional investment accounts can't do self-custody of cryptocurrencies. And so Grayscale solves that problem, as does Bitwise and a few of the other players, CoinShares and others, who also create exchange traded products. So Digital Currency Group is a unicorn, both because of these operating companies where it's the majority owner of the equity, but also because they've been very active investors in other blockchain businesses. And Digital Currency Group has a portfolio of about 100 or more investments that it's made, and many of those are emerging or actual unicorns in the blockchain space. And we're investors ourselves in Digital Currency Group. And then the final and the newest of the blockchain unicorns is Figure. Figure was founded by Mike Cagney and June Wu. Mike had been the CEO of SoFi, which is one of the leading fintech unicorns. And Mike decided to create a new company in 2018. He was very well backed by DCG, who we've just spoken about, and a variety of more traditional investors. And his goal was to do two things. The first was to create a mobile-first platform for people to borrow money for home equity loans. So it basically allows you to borrow against your house, which is a very big market in America. And Figure is intending to be the simplest way for people to do that. But in addition, Figure has created the provenance blockchain as a way to both ensure the provenance of the loans that they are making through the Figure application, but provenance can also be used potentially for other purposes too. And so this company's most recent investment round was valued at more than $1 billion, and so it joins the list of blockchain unicorns. So wrapping this up, just to repeat and to summarize, we have 16 blockchain unicorns at the beginning of this year. We hope there'll be more. Obviously, we're living through a global pandemic, but we hope that there'll be additional companies joining this list. These are the ones where we're investors, are blockchain co-investors, mostly in the US. There are also BLOCK.ONE, BitFury, and DFINITY. And if you want to learn more about what we do and how we are investors in those companies, please come to blockchaincoinvestors.com and just sign up so we can speak to you. And if you want to learn more about everything I've spoken about, we published this book, which is available everywhere, Apple, Amazon, Smashwords, and so on around the world. And we encourage you to read this book if you want to learn more about blockchain and digital monies and digital assets. And these are my personal contact details. I enjoy very much, Nadia, being here with you at La Token. And I hope that this has been valuable to your community. And don't hesitate to contact me if you have questions about investing in blockchain unicorns. And so with that, Nadia, let me hand back to you.
Thank you so much, Matthew. So it was an in-depth overview of a lot of unicorns across the world. What would be your key advice how to identify these unicorns early on? It's quite an extensive investment process. And
Yes.
You are an investor in
Yes.
a great deal of them.
Yes, thanks, Nadia. It's a good question. So for investors who are listening to this, you have a couple of choices. One is you can be a late stage investor in these companies. And so, for example, a company like Ripple, you can get equity in Ripple by going to link2, linqto.com. And that's open to most investors. So investors can be late stage investors by buying secondary stakes, often available in the public market, in the private markets. However, to be an early stage investor is a very complicated undertaking. And I would say our strategy is to stay close to the best investors globally in blockchain. And so that's what we do at Blockchain Co-Investors. We are limited partners of the top 10 blockchain VCs. And we believe that most of the best investments come from the best investors. And that's certainly what we saw in the internet. Here in America, in Silicon Valley, where I'm based, we have about 1,000 venture capital firms, but only about 50 or less of those 1,000 have ever backed a blockchain unicorn. And people like Sequoia and NEA and Kleiner and Draper and Andreessen may have backed 20 or 30 or 40 each. Meanwhile, 950 of the venture capitalists here have never backed a unicorn. So my answer to your question, Nadia, is if you're an investor and you want to be early into these types of companies, make sure you're investing with the best investors.
Yeah, it's a very high competition for high quality pipeline there, especially in the Silicon Valley. And you also gave us a keynote on early stage investments for our investor community. Would you also highlight maybe some of the niches which are of the top priority for you, or your co-investors, the leading funds who are currently looking at the new unicorns which are not yet on the list?
Yes. So at Blockchain Co-Investors, we have a combined portfolio of over 100 blockchain companies through our investors that we are limited partners of. And many of those are emerging unicorns. So I'll name some, but there are a lot. And most of them are well-known companies. So it could be Securitize and Bitwise, where I'm personally involved. It could be Backed or blockchain.com, which are also, they're not yet unicorns, but they have substantial businesses that they built in blockchain and they're beginning to gain traction. Obviously, in the case of blockchain.com, they are a little bit more retail focused, whereas Backed is much more institutionally focused. So these are examples. I think that there are some interesting new protocols developing. I might mention the NEAR protocol based in Switzerland as being an example, but there are others. So I think on this particular webinar, it's hard to talk about those emerging opportunities because there are so many of them. And I should also say that I'm not providing direct investing suggestions or presentations on this call. But those are some of the companies we're involved in and most excited by.
And what do you find in common across all the unicorns? How do they cope with the current situation, and what is the core of their strategies that helps them to succeed?
Right. So Nadia, I think the second half of that is the easier part to explain. The world is transitioning to a fully digital world, and we're only about halfway there. So we built the internet over the last 20 years, which is a global communication platform. Now we have to build a global transactional platform, which means we need digital monies and digital assets as well. And most of the companies we've just talked about are focused and are benefiting from this transition to a fully digital world, a fully digital economy. And so all of them, whether they're mining companies, whether they are wallets and exchange companies, they're all pretty much focused on the transition and the emergence of digital monies and digital assets. Now, in terms of how are they coping right now with the virus and the pandemic that we're sitting in the middle of, I think that most of them are being very disciplined. Most of these companies have a lot of cash on their balance sheets. I think most of them are run by experienced teams and CEOs. And so they've been accentuating the focus on revenue. They've been reducing cost. They've been ensuring that they clean up their balance sheets and that they have a lot of cash on hand. And I also think most of them have been thinking about their roadmaps and what activities they need to continue to invest in this time frame, be potentially putting on hold. We've also seen a number of these companies begin to take a look at acqui-hires. The expectation we have in America is that there'll be a lot of bankruptcies of blockchain companies over the next 6 to 9 months. And these leaders are all in a position to acquire weaker players. And I think it's partially in that regard that we're beginning to see announcements of the acquisition by these companies of smaller blockchain businesses. And I won't spell any out, but there have been a lot of these announcements. And we saw that in 2008. We saw that in 2001. When we go into the downturn, the strongest new technology companies oftentimes acquire some of the weaker ones that are running out of money.
Thank you so much, Matthew. And I'm bringing our new keynote, which is Chuck Hattemer, co-founder and CMO of Onerent, will be presenting a keynote on contactless rentals. Chuck, could you briefly introduce yourself?
Thank you.
All righty. Yep, here I am. Hello, guys. I'm Chuck. I am the co-founder and CMO at Onerent. We are a residential prop tech company in the rental space. Today, I'm going to talk about contactless rentals and how software is eating the world of real estate services next. So I can go ahead and I have a little presentation I can share. Nadia, should I screen share that?
Yeah.
Great. Okay, 1 second. Okay. Okay, so let me just go ahead and pull this up. So can you see my screen?
Not yet.
Okay. Hold on. All right. Can you see it now?
Yes. Perfect.
Okay, great. So yeah, so thanks for having me, Nadia, and the group here. So today I'll give a little bit of an overview about how software is eating the world of real estate services and how kind of contactless rentals plays into that. So, you know, there's a lot of news coming out, about the future of many different industries, future of work, future of travel, and real estate is top of mind for many people. What's the future of real estate? So, something that we've been working on for about 5 years now is the future of rentals, and this idea of being able to shop for real estate like you would shop on Amazon. And what we've discovered is that the only way we can do that is by being a full stack solution. So that's kind of central to this thesis here that we have, which is that software is eating the complex offline real estate services world. So my name is Chuck. As I said earlier, I'm co-founder and CMO at Onerent. Onerent is a full stack prop tech company offering residential property management services. We serve about over 10,000 homeowners and renters across the west coast of California. And I'd like to start by kind of helping everyone understand what is real estate technology. What is this idea of prop tech, right? And really the way to think about the prop tech revolution is through a series of phases. So there's really kind of 4 or 5 big phases of real estate technology and prop tech. And the first one is really the listings era. So the listings era, this started in the late 90s and early 2000s. And real estate technology really got its start here. A lot of consumer technology really got its start. And you have companies like Zillow, Trulia, Realtor.com, all in the platform space, and they're building these online platforms. And the whole theme of this era was unlocking information. It was kind of part of the information revolution, right? And it used to be that all the information about what properties were for sale or for rent was protected by real estate brokers or real estate offices, and you had to go to those offices to actually find out about available properties, or you had to open up the newspaper and look at listings in the newspaper. So the listings era was about taking an old medium and an old experience, looking at listings in the newspaper, and just turning that into a new medium, which is the internet. And this happened, we also saw this happen with newspapers. You look at the New York Times, the first New York Times online homepage looked exactly like the newspaper, right? But it was online. And that's kind of how the internet first started, is people took things that were offline and just put them on the internet. They didn't change the experience. It was just a new medium. So just like you look at newspaper listings, you also look at those listings just online on Zillow or Trulia or those other sites. Now, the next era is what we call the unbundled Craigslist era. And this is the era of marketplaces. So you look at Craigslist, right? And Craigslist is an example of a listings era technology and site. And frankly, it's kind of stayed there ever since. Craigslist, for anyone that doesn't know, is probably one of the most popular kind of classified listing sites in the US. Does over 600 million in revenue. Famously only has a team of maybe 20 people, and it's famous for its design, which hasn't changed in years. And real estate took a look at this, and it became about the unbundled Craigslist era. And this happened across all sorts of consumer tech. So you look at this is a famous graphic here that we see on the right, and it shows all the different categories of Craigslist and the companies that spun out of it. So you have, lists in regards to real estate, you have listings like Zillow or Airbnb famously took over the short-term rental or room shared category of Craigslist. You have, Upwork or Thumbtack that are taking on different services, different categories. So this is all about unbundling Craigslist and turning it into other future platforms. Now, this, like I mentioned, this is really the trend of most consumer technology. You had the listings era in the 90s, the unbundled Craigslist era in the 2000s. But then, most consumer technology in around 2009 time started to go into what we call the Uber for X era. Now, real estate took a different path, but I wanted to highlight normal consumer technology, or most of consumer technology, because we can see how fast it evolved from listings in the 90s all the way to what we call managed marketplaces in the mid 2010s. So this is the development of most consumer technology. This graphic is from a very well-respected venture capitalist in Silicon Valley called Andrew Chen. And he talks about how, the Uber for X era was really about starting to take control of the whole transaction, and do things like automatically match two sides of a marketplace. So an Uber rider and an Uber driver, communicating with that Uber rider and driver, booking that car to come pick you up in the transaction. And then the mid 2010s, most consumer tech evolved into the managed marketplace era, where you started to get into some more kind of sensitive industries or markets or services that require more trust in the marketplace. So this was all about, guaranteeing and protecting trust in the marketplace, helping people discover these services. And so we have examples like Wonder School, or education technology, Honor, which is senior care. So these are things that are very sensitive kind of services or products and marketplaces that eventually went online. Now, like I mentioned, real estate followed a little bit of a different path. So what happened is the listings era really stuck around for a long time. And you see that these sites like Zillow, Trulia, that really got started in the listings era, they started to morph themselves into the unbundled Craigslist era, where they started to take control more of kind of the transaction and helping people discover, service providers. But their whole business model was built on the traditional business model. So Zillow, their business model up until recently, when they're trying to switch it, was built on advertising for real estate agents. Same thing for Trulia or Realtor.com. But it really wasn't changing the fundamental experience of buying a home. It was just selling ads to real estate agents. So they couldn't, because their customer was the traditional industry, they couldn't just go and disrupt the way that properties were bought and sold. They just had to sell leads to those traditional industry. And they did that for years. And it wasn't until the last couple of years that they said, hey, maybe we should compete a little bit with the agents that we sell ads to, because you can earn more, you can control more of the experience, and you can actually change the process. Now, in 2009 to 2018, that's when real estate deviated from normal consumer technology, and it kind of got stuck in the smart home era and utility marketplace era. And these are some of the examples of companies that fit that criteria. So, they were controlling some of the transaction. They're allowing people to pay each other through their platform. And it was all about, incorporating more data science and AI and using the data of the marketplace to help drive things like the Zestimate, which gives a prediction for the value of a home. But again, they weren't fundamentally changing the service or the experience of buying or selling a home. Now, where's disruption happening now? Well, we believe that it's in services. And this is why we think software is eating real estate services next. So prop tech is kind of the term that encompasses all of real estate technology. And as you can see in the background here, there's tons of different categories that cover prop tech. And it can be everything from those listing services into what we do at Onerent, which is full stack, controlling the entire service and actually changing the way that we rent a home. And prop tech is a huge market. It's a $3.5 trillion market in the US alone. So if we think about residential brokerage commissions, generates about $80 billion each year. Rent, there's about $500 billion of rent that changes hands every year in the US between renters and landlords. Commercial real estate, even bigger, which is going to be under a lot of pressure post COVID and the pandemic. That's about a $1 trillion market. Construction, even bigger, about a $2 trillion market. So it's a huge market. Real estate is the largest asset class in the world, and arguably the most valuable company in the world will be a real estate company. So why has real estate lagged behind? Why has it been slow to innovate? I mean, we still, in much of the world, we still buy, rent, sell homes with paper and pen, or with a handshake deal, right? So it's very offline. The first reason is regulations. If you look at across all industries, the industries that have the highest amount of regulation tend to be disrupted last, and that's because it's just more difficult. It's just, there's more complexity in the equation. You've got to overcome some of the regulatory hurdles that might block you from trying a new kind of a new sort of approach to renting or buying or selling a home. And it costs a lot more money to get through those regulations. And we've seen this with Airbnb. I mean, Airbnb has spent hundreds of millions of dollars on regulatory change and getting people to, getting cities to allow short-term rentals, or in some cases, cities blocking short-term rentals, like in New York City. So regulations are a big reason why it's been slow. Number two is that real estate is a complex offline service. There's a lot of different moving parts. And for that reason, people have only picked out little pieces of the real estate experience and turned it into a platform or a technology. But again, these are purely just platforms. They're not actually changing the fundamental way that the transaction happens. And then number three is that real estate requires a lot of trust to build up. So it used to be that we didn't trust getting into a stranger's car, but now we use Uber just like it's, like it's nothing to us, right? And that's because that Uber helped build trust in the marketplace between riders and drivers. And that needs to happen in real estate. The reason why it's more difficult in real estate is that it's a much larger transaction size, right? And it's a much deeper relationship that you have with the service provider. Whereas Uber, you take a trip from point A to point B and it's over. Real estate, there's a lot more money on the line, and it takes a lot longer. There's a lot more steps in the process. So real estate has lagged behind. You think about Uber, you can go through the whole experience from requesting your ride to booking that ride, all the way through to paying and rating the service, all in one seamless mobile application. For real estate, the best thing we have is online web forms that help you contact a real estate agent. But as soon as you contact a real estate agent or a property manager, traditionally, everything happens offline after that. It's all phone, email, very fragmented experience. So why is change happening now? Well, one thing that I don't have in this presentation and I think is important is that COVID has been an accelerant to the development of technology in real estate and an accelerant to the change in consumer behaviors. So why now? Number one, we trust the internet now more than we ever have before. We are starting to take very serious, large transactions and decisions online. And especially with COVID and the impact of the global pandemic, people are being forced to basically transact online or do things more virtually. And this is going to accelerate the trust in the internet and the marketplace. Number two is that more and more people involved in the real estate market are starting to handle the experience online. So you look at this data from NFX, a prominent venture capital firm in the field of real estate technology. And you see they classify, what I called as the listings era as the information revolution. So you can see that here. This graph shows the number of buyers that found their home online. And think about, Airbnb launched in around 2008. And at that time, Facebook was around, technology was all around, but still only about 30% of people found their home online. Now that number has gone way up. It should be well over 50% now. This is a few years old, this graph. But that was largely driven by the transaction revolution, which is similar to what I'm calling kind of the services revolution here. The next thing is investment is growing. So there's been a ton of money put into real estate technology. Last year there was a survey and 60% of prop tech investors planned on making even more investments in 2019 compared to 2018. And real estate, if you look at the number of the amount of funding in 2018, it had over nearly $4 billion of funding alone. And why? Well, because real estate is such a huge market. It represents 17% of America's GDP. Big investors like SoftBank poured billions of dollars into companies like Opendoor or Oyo Homes, which is a big real estate technology company in Southeast Asia. So there's been a ton of money poured into real estate. And another key point is historic inevitability. This just like travel was bound to be disrupted, and like the taxi industry was bound to be disrupted at some point, because the whole taxi licensing system just didn't make any sense. It's historically inevitable that real estate was going to face disruption, and that technology is going to kind of take over more and more of the service experience. So this graph, I want to take us back in time and highlight why it's historically inevitable. So let's go back to the Industrial Revolution time, and let's look at the trend of real estate during the Industrial Revolution, because what we're in now is kind of the second or third Industrial Revolution that we are in today. So it's important to look at history as an example. So in the Industrial Revolution, you see that at about the mid 1700s, the British Industrial Revolution started, and you see here the impacts on the average rents for homes, and how after the Industrial Revolution rents started rising. And this is very similar to what happened, for example, in San Francisco or across the US when the internet revolution started. House prices started skyrocketing. And even to this day, California, San Francisco, San Jose, these are some of the most expensive places to live in the world. And that all came about largely in the last 30, 40 years since the internet revolution. Now, let's also look at real wages and income by decade. So this is also England and Wales, and this shows real wages and income during the Industrial Revolution, and how they didn't quite change like rents. Look at the graphs for real wages and incomes and compare that against the graph we just saw, which is rents, and you see that they're not changing much. So there's this bifurcation in rents, that the average rents for housing, and incomes. Does that sound familiar? That's exactly what's happening in many places affected by the internet revolution. Rents are skyrocketing, but real wages and income is not matching that pace of growth. Now, the last thing to look at is quality, housing quality. Now, if we look at the British Industrial Revolution, and we look at this is an average housing quality index that's prepared by professors and researchers over at UC Davis, and it shows us the quality of housing during the Industrial Revolution. And you see that during the Industrial Revolution, the quality of housing actually went down slightly, and it took nearly 100 years for the impact of the Industrial Revolution to reflect on the quality of housing. So real estate has always been a laggard. Real estate has always been reactionary, and we've seen it happen before in history. So again, there's been a bifurcation of income, of rents and incomes, meaning rents and house prices are going up faster than income. The quality of housing has not dramatically changed since the internet revolution. And that all of those things are going to kind of cause a big seismic shift to happen in the industry within over the next 50 years, and it's happening now. And here we show that, you know, you have rent again. This graph looks very similar, right? You have after the internet revolution in the 80s, you see the median gross rents start going up in the 90s, you know, 2000s up to 2016. But the renter income has stayed relatively stable. And that's, again, housing costs are increasing faster than income. The quality has improved only marginally. So if we look at a American Housing Survey and the Poor Quality Index, we can see that it's actually gone up and only slightly gone back down after the kind of the internet revolution, and the quality has not changed. So it's starting to look very similar to what we saw in the Industrial Revolution. So who is impacted by this revolution? Well, first, it's going to be real estate professionals. So real estate agents, real estate brokers, anyone involved in the transaction process of real estate is going to have to change how they do business. Approach things from a technology first perspective. They're going to have to improve the quality of housing, you know, as incomes start to rise, right? But it's all going to happen later than other industries. Second is going to be real estate technologists, people that are building the future, right? They're going to have to think about, what does this future look like? You know, how can we you know, fundamentally push forward real estate and housing? How can we make housing better and a more pleasant experience, more affordable? These are going to be big questions that real estate technologists are going to have to answer. And then buyers, sellers, investors, renters, all the consumers in the market. I mean, we already saw that in the graph I showed earlier with the number of people that found their home online first. It's already changing, right? The people are already starting to experience online. During COVID, for our own business at Onerent, we've seen over a 200% increase in the number of people renting a home virtually, sight unseen, right? And that's largely due to the shelter-in-place orders that have been put in place. But our belief is that some of that consumer behavior change will remain changed after COVID. So this has been really an accelerant to this revolution. And where is PropTech going next? So first is going to be increasing liquidity in the market. When you're able to control the entire experience of renting or buying a home, you can increase liquidity in the market. You can make transactions happen faster. And that can be done using a mix of capital, smart capital allocation, and technology. And we see Zillow, we see Open Door, some of these what you call iBuyers, which are the companies that go and buy your home from you and then resell it. Their goal is to kind of help increase liquidity in the market, make things happen faster and more streamlined. The next place it's going is this one-stop shop. People are tired of having to deal with 50 different platforms just to buy or sell or rent a home. It's a very fragmented experience, and there's a lot of fallout in the process because of how fragmented it is. So the future of real estate is going to be a one-stop shop. You're going to rent a home from a company. That company is going to help you buy your first home. That company is going to help you invest in real estate. So there could be this kind of one-stop shop solution. And then next is blending tech with services. So the online world and the offline world are going to meet, and you're starting to see that in some of the applications of technology like virtual tours, 3D scans of properties. So the offline world is meeting the online. Here's some of the ways that we're doing it at Onerent. So we build a product, a conversational platform called ACE. And ACE is a product that helps you automate the whole rental process from beginning to end. And because we control both the offline and the online parts of the process, we can kind of seamlessly tie these things together. So we have, a pricing engine, we do property owner identity verification, we schedule property inspections, we list the property, we automate updates, and that's only possible because we're controlling the full stack. Again, the blending of tech and services happens also on the renter-facing side, where our ACE product helps automate things like virtual tours or rental applications, or even signing a lease and having that human fallback support. I'm going to skip through here, and then this is one of the great ways to kind of see this revolution happening in action, which is maintenance. How do you actually bring technology into something as complex and offline as property maintenance? So what we've built is a product that helps tenants troubleshoot maintenance issues with an AI, with artificially intelligent bot. So this is one of the ways that we have implemented technology into the offline experience. And the only way that this is possible to do a full stack maintenance troubleshooting through our product is because we have visited every home, we've scanned that entire home, and we've documented things like where the plugs are, where the circuit breaker is, what kind of appliances are there in the home. So we've taken all of that offline data and we've brought it online. And that's a key theme that we see in this real estate revolution, is bringing offline data back online. And that troubleshooting helps save costs. We have nearly 30% of our maintenance issues can be resolved with troubleshooting, which means no humans involved. It's a zero contact solution, and it uses machine learning to train the system every time we do a maintenance troubleshooting. So if you have an electrical issue and you need to go through the process of resetting the circuit breaker in your home or the outlets, things like these that are common maintenance issues, we can troubleshoot them without any humans involved. So that's what we mean by a full stack solution, beginning to end. So how can you stay on top of this revolution? So some key takeaways. Number one is realize that real estate shares the same fate as banks. There's a huge opportunity in this transition. What do I mean by that is that local branches, local offices are losing meaning, just like they've lost meaning in banking. That's also happening in real estate. Using a distributed model where you have things handled in the cloud improves efficiency, and offline data is coming online. So how can you stay on top of it? Well, number one is embrace new technology, right? Bring in this new technology into your business process. Look at your business process from beginning to end and see how you can shorten the time to conduct business and increase the quality of service provided. And you can do that with technology. Centralize operations. So what that means is consider if you operate a business that relies on local branches, consider centralizing, what kind of some part of your operation, and see if you are able to actually operate a more on-demand sort of Uber model where you don't necessarily have a local office, but maybe you have people in each market that are kind of contractors that are on demand for anything that requires that physical presence, because everyone knows paying for offices is one of the most expensive costs, right? Automate when you can. So automate as many parts of your process when you can, but don't over automate, because again, one key aspect is you need to have trust in the marketplace. So you should still build teams of experts for each part of your business process. So if you're a real estate agent, maybe you can automate how people book an appointment for an open house. But maybe you need teams of experts to help with the negotiation with the buyer, between the buyer and seller. So those are the ways that you can kind of balance technology and the human touch. So with that, I want to leave everyone with this, which is that the prop tech revolution is upon us. It's historically inevitable. We saw it happen in the Industrial Revolution, where it took about 100 years after the Industrial Revolution for the quality of housing to actually improve and the experience to improve. We're about nearly, almost 40 years into the internet revolution. And arguably you could say that, even longer, we've been in the technology revolution, the kind of second industrial revolution, for maybe 50, 60 years. And that is going to have an impact on real estate, but we aren't going to see that full impact right now. But it is starting now, and it'll happen over the next 10, 20, 50 years. 50 years from now, real estate housing is going to look completely different. And that's it. So thank you very much, and feel free to reach out, connect with me on Twitter. There's my Twitter, C_Hattemer. You can scan this code as well. Connect with me on LinkedIn. I'd love to talk to people that are involved in the prop tech revolution, and also learn about other industries and how software is eating the world of services in other industries as well. So thank you very much, Nadia and the team.
Thank you, Chuck, and thank you for this presentation. And we also observe such trends, as you mentioned, in the construction business as well. And at the very early stages, from the very first drafts and designs to all the repairings and all this stuff. Could you also briefly mention that for the construction industry itself?
Yeah, absolutely. So for construction, it's like we saw, that was the biggest industry, right? It's a $2 trillion industry. So it's a huge market. And for construction, some of the technology that's really interesting to me is the 3D mapping and kind of 3D scanning technology, and understanding how people are using space, and then incorporating those learnings into the construction and design of space in the future. So one of the famous examples of this is WeWork, where WeWork does, claims that they have, a technology. They bought this company called Field Lens, which is a technology that helps scan, how people move around an office space and where they spend time. And they use that information to design the build outs for their new locations or new offices. So it's most optimized for how people want to work, where they want to spend time, what kind of color palettes they like, things like that. So that's also happening in residential. And we are collecting that data today, where we measure the foot traffic in a home. So for example, when someone goes to visit a home, where are they going within the home? Where are they spending time? What matters to them if they decide to rent that home? So that kind of information can be used to build more higher quality housing, and ultimately more affordable housing as well.
So, and we again get back to this issue of gathering big data. So anyway, all these segments, they go to big data anyway. So as you mentioned, and Internet of Things as well, artificial intelligence, and all these trends, and automation of all the processes, and unification of all the systems across the world, including the standards of construction and different parts and repairs. And Internet of Things also helps with that, as you mentioned, for the home repairs, right?
Yes, absolutely, absolutely. So every home that we have a a smart lock on the home, and so this allows for easy access into the property. It also helps us, kind of see how people are accessing the home. And one of the really big missing pieces of data that's existed in the real estate market is all of this offline activity that happens after that first touch with a real estate service provider. So because these platforms only connected people with a service provider and then let the service provider handle everything from there on forward, they didn't have visibility into all that data. So the rent estimates that you see online, for example, are based off of listed rent prices. They're not based off of actual leases that are signed, because no one has visibility into that data at scale. So that's really going to be one of the big changes we see, is all this offline data is extraordinarily valuable. That's one of the reasons one of our backers is the chief of AI at Google, Jeff Dean. That's one of the things he saw in Onerent, and what we're building is the opportunity to collect to bring all of that offline data back online.
Yeah, and also the use of property, how to make it the best market fit, how to use the already constructed buildings, for instance, to go from retail, different types of retail centers to residential and so on. So conversion of business centers which are not in demand in the current environment, maybe. So
Yeah.
would you comment on that as well?
Yeah, I saw one of my this guy Keith Wasserman. He's a acquaintance of mine, and we go back and forth on Twitter. And one of the things he said on Twitter was, minor league baseball stadiums should be turned into Airbnbs, or commercial office space should be turned into residential, because there's going to be a lot of change, especially after COVID, and with a lot of people questioning the future of work, the future of travel. A lot of these real estate assets are going to transform their use. Like, you may have office space that's redeveloped into residential. I think the joke about the baseball stadium was, minor league baseball might not fare that well after this pandemic, because number one, it wasn't, that popular to begin with before the pandemic. And number two, now people are going to be more hesitant about attending sporting events. So just like we heard in the last panel, or a previous panel that we talked about, I believe here, it was, someone was saying that, the people that the kind of company, or in education, the second or third tier schools are going to be the most impacted. First tier schools are going to be relatively okay because of the brand name. Same thing is going to happen in real estate, where top tier real estate is still going to probably be, just as expensive, just as in demand. But second and third tier real estate, especially on the commercial side, is going to be redeveloped, repurposed, rezoned, and we're going to see a whole change in the kind of the mix of types of real estate in the market.
Thank you so much, Chuck, and we welcome you to join our further panel discussions of Startup Leaders Club, and join also our masterclasses and keynotes for the further topics. Awesome. So, yeah.
Great,
and,
thank you.
We wish you good luck, and thank you for our today's keynote, and we share it on our VCTV, which is online 24/7. So good luck in everything you do, and just let us know if you want to show us more data and some of the progress in your team. Thank you so much.
Awesome. All right.
Yeah.
Thank